Good morning, Matt. My name is Sebastian de Montessus, and I'm the CEO of Endeavour Mining. So Endeavour Mining is a top 10 gold producer globally with a competitive advantage and strategic focus in the world's largest gold producing region, West Africa, currently producing about 1.1 million ounces at industry-leading all-in sustaining costs, or production cost of $950 per ounce. We're regionally focused, but diversified with 4 mines across 3 countries, both in Senegal, Côte d'Ivoire, and Burkina Faso, along with 7 advanced development projects and over 100 exploration properties. We tend to actively manage our portfolio to focus on assets with plus 200,000 ounces of annual production, but also with, which is very key for us, industry-leading all-in sustaining costs below 950 and over a mine life of at least 10 years. We recently divested 2 non-core assets with higher cost, Bungu and Wanyou mines in Burkina Faso, improving our group cost by about $40 per ounce, $45 an ounce, and with high mine life. And while also diversifying the portfolio further, we obviously have less exposure to Burkina Faso. And we are able, to diversify because we've been also focusing on growth projects, and we're currently building 2 projects, Lafigué in Côte d'Ivoire and Sabodala-Massawa expansion in Senegal. So very pleased, to be here again, Matt.
Well, good to see you, Sebastian. Right, so growth, very, very important part of what we're going to be discussing today, but also in the backdrop of record high gold prices. Not too bad at the moment, isn't it?
Can't complain. Good business to be in, but we've been waiting for that, and I think that's just the beginning. We all know that once interest rates in the US would have topped and started to potentially decrease and revert, then this would be probably a good window for gold price to rally. What is surprising is still, and this is where I think there are some opportunities for your audience, Matt, is the significant discount that we see today between the gold price and the gold equities. So clearly, a lot of opportunities still to be made, for investors.
Right. Okay. And if I look at some of your big holders, and if I look at some of the people covering you, I'm sort of intrigued as to what they're looking for. What do they need from you? So let's talk about some of the moving parts that you think are important. Obviously, one, increased gold production. So what's going to be driving that?
Well, I think that's the fact that we are one of the lowest gold producer means that whatever the gold price, and in particular in current environment, we are able to generate very strong cash flow. And we've been for the last 3 years putting a progressive, I would say, aggressive shareholder return program, which allowed us, so far, to return close to $800 million, to shareholders by way of dividends and buyback. And so I think we've got an attractive overall yield on Endeavour. And on top of that, we have our own organic growth, strong organic growth profile, 1.1 million ounces this year, but we're going to be, producing from 2 new mines next year with Lafigué in Côte d'Ivoire and the expansion at Sabodala-Massawa. And we've made also a major discovery last year at Tanda-Iguela, which I'm sure we're going to talk about. So we basically have the chance to have a significant organic growth pipeline within our portfolio, allowing us, to continue to deliver, very strong results and cash flow for our shareholders.
Okay, so if I may, can I just start with kind of portfolio tidy up that you've been doing this year? You referenced that earlier in the conversation. We're looking obviously Bungu and Wanyou, slightly higher cost profile there, but nevertheless, in this gold environment, presumably would have been capable of making money. So why get rid of those?
Sure. Well, we've got this, we've talked about in the past, this, magic box, concept, where we want to continue to maintain a low cost, asset base. So assets which overall the portfolio allowing us to produce below 950 all-in sustaining cost and with at least 10 years mine life for each of the assets. And also to be above 200,000 ounces of annual production per asset. So, solidifying, this, type of asset base. And at the same time, we always said that we wanted to be focused geographically in West Africa, but diversified over several countries. So we had, I would say, a significant exposure to Burkina Faso on the back of the acquisition of Semafo and Teranga. So Wanyo and Bungu were basically, assets with, higher all-in sustaining cost than the Magic Box and shorter mine life than what we want for the Magic Box. So we felt that it was, a good way to, continue to be extremely disciplined on the quality of our portfolio, and also at the same time to de-risk a bit geographically by, increasing our presence in Senegal and in Côte d'Ivoire, and therefore reducing our exposure to Burkina Faso.
Okay, interesting. And with regards to I think you talk about a sort of $300 million there, but it was 130 million of cash up front, and the rest sort of, I think there's another 25 million coming imminently, end of Q4 and end of Q1 next year. What do you do with that money? What's the best use of that money? Is it developing your organic portfolio, or as some of your shareholders are thinking, oh, maybe now's the time for some M&A?
No, I think so far we've been, building those two mines, which will go into production in, end of Q2, beginning of Q3 for both of them. We're probably one of the rare company being able to develop, two projects at the same time, and still, making sure that we deliver those projects on time and on budget. So it's a total of, close to $800 million in CapEx, that 750, I would say, that we've been investing since last year on to develop, those two projects. So clearly being able, to get cash out of the asset sale allows, to maintain a very strong balance sheet. We expect that we will peak at some point during construction at, no more than 0.5 times net debt to EBITDA ratio, which is, pretty healthy, balance sheets while, building, two mines at the same time. But very quickly we'll be, coming back to a net cash positive on the balance sheet on the back of the delivery of those two projects. And the objective is to progressively, in particular in this current gold price environment, be able to have this, progressive, shareholder returns, to our shareholders, by being able to progressively continue to increase, our dividends and buybacks.
Right. Okay. And do you think you've got any lessons that you've kind of learned with that disposal there? Because I'm trying to work out the reaction in the market in terms of the share price. Obviously, it kind of went down off the back of that, recovered in October, which is obviously good news. But was the market understanding why you were doing it, what you were trying to do, and and how you were going to deploy that capital?
Sure. I think the market was extremely supportive, of the sale of those two assets. I think the drop in the share price that we saw has been, the combination of two factors. One, is the market. We got during that period, we got gold price, going down back, significantly compared to where we are today. And also there was a lot of geopolitical risk, around the region, with a coup in Mali and a coup in Burkina Faso. And therefore, given our exposure, to Burkina Faso, probably, overreaction on that, geopolitical risk. So the fact that we were able to reduce that exposure by selling those two assets, has been, well perceived. Bear in mind also that we are in construction phase, and usually, given all the blow-ups, in the market in the past, with project being delivered, with over budgets, delayed, and so on. There is always during those construction phase, investors who can be worried or standing on the fence, before coming back to the name. So that we've seen that a bit during, I would say Q2. But I think the strong signals that we've given to the market that those two projects are progressing extremely well, that we've mostly de-risked all the budget, with for both projects more than 85% of the capex already committed, without any surprises on budget numbers, and the fact that those two projects are progressing well means that we should be again delivering those two projects on time and on budget, which has been one of the strengths of Endeavour, because we've got this strong construction team internally that allows us, to deliver two projects at the same time and still deliver them, on time and on budget.
Okay, and do you think that obviously, on time, on budget, 85% invested, and cash in the bank, is that going to allow you kind of break away from this kind of proxy to gold price, that correlation that you've got going on at the moment? Because we come back to that growth question, which is how do gold companies, producers, demonstrate growth and sort of decouple away from gold price, which is not necessarily a bad thing at the moment, but you know what I mean? We always want more. So is that enough, or is it going to come from things like, you've just announced with Tanda-Iguela, increased resource, etc.? Would you need something even more I guess exciting. Like M&A always seems to get people going. Would that be smart?
Well, I don't think that in the current environment and given where we are, we need to go. I mean, for any particular M&A transaction, first of all, because of the discipline we have around the quality of the assets. I mean, we don't need, to grow through M&A for the sake of size. I mean, if we wanted to be a 2 million ounce producer, should have just kept, the assets that we had in the portfolio. But rather than that, we prefer, to be extremely disciplined and focus on a very strong quality of portfolio. So I think what the market is looking at Endeavour is, our ability to deliver what we say. And we've been doing that constantly, over the years. The fact that you have, strong production, but on top of that, low cost, compared to the rest of the sector. Surprisingly, most of the sector is now producing at, 1,300 all-in sustaining costs. So there is a big gap between where we currently produce and where the rest of the market is producing. And we've got this, organic growth that, we've been demonstrating year after years. La Figuier that we are currently building is an asset we discovered back, 6 years ago, and it will be in production next year. So Tanda-Iguela that we just discovered is probably, one of the biggest, West African discovery for the last, decade. And this will be a major tier one asset in our portfolio, going forward. So the market can see that, we are able to find, ounces at low cost. We are able to build, mines, and we are able to operate them, with low cost, which in return allows to generate strong cash flow and have this, attractive shareholder return program for our shareholders.
Well, tell me about that, because I've spoken to at least a handful of CEOs of gold producers over the last 2 weeks. They're saying there's a new paradigm. There's a new kind of cost base for them, and that, I've been quoted as high as $1,450 as the new norm by a couple of CEOs, which obviously to shareholders would seem extraordinary, but there's been a lot of pressure previously because of COVID and supply chains and therefore inflationary issues. Why is West Africa immune to that?
So I think it's you're right, and it's interesting to see that some CEOs in the sector are now saying that it's going to be difficult to see some reduction in all-in sustaining costs, because the market has been for some of them expecting that after the high inflation environment, COVID and all that we would see, a drop, in cost. And I don't think we're going to see that for a lot of companies, in particular the ones operating in, developed countries, North America, Australia, and so on, because there are things that will never go back down. You take salaries, for example. Suddenly you're not going to, in North America, you're not going to start, paying lower salaries, to staff. So there are a lot of things that are not going to drop, and therefore it's probably going to be a new norm. And that's the beauty of West Africa, is we've been partly, immune, to some of it, simply because, if I take the case of Endeavour, in terms of salary, we've been working a lot on growing local talents, which means that, we're proud to say that we want to develop local talents. So if we have expatriates that are not happy, with their salaries, we've been training, new people in the region, which are extremely good, and we are not short, of labor. There is so many that wants to join, successful mining companies in West Africa. You take another example, which has been successful, in West Africa, is our ability, to build very quickly in new mines. The permitting process, in average, it takes less than, 1.7 years, to develop a project. It takes between 40 to 60% more time and sometimes more cost, to build in North America and in Australia, for example. So it has been the most prospective region in terms of discoveries. It is extremely efficient in terms of building, and you still have, lower, I would say, average cost than other regions. So, the downside is probably, the perceived geopolitical environment. But if you are diversified like we are, over several countries, we never had any, incident on any of our mines. We've been, managing that risk, for our shareholders.
Okay, so it's quite interesting to me in terms of that de-risking component. I want to look at some of the other things that you're doing. Obviously, the recent announcement with Tanda-Iguela, moving more of the resource into the inferred category. Why does that get you bonus points with the big funds that are supporting you and sticking with you?
Again, I think it's consistency over the years, and the fact that most of our shareholders, in particular the largest ones, are not going to wake up one morning thinking, those guys have done something crazy. I think they see that we are disciplined. and we keep delivering, again, both on production, on projects, and on exploration. Tanda-Iguela is a very good example. Last year, no one knew about Tanda-Iguela, and we came out with the first resources, 1 million ounces of indicated and 2 million ounces of inferred resources at 2 grams a ton. And this year we've been, exploring significantly. Overall, we've done close to 150,000 meters of drilling just this year, on Tanda-Iguela to accelerate. And we came out, with this, significant upgraded resources, showing last week 4.5 million ounces of indicated resources at 2 grams a ton. This is a major discovery. And I know that, some of the benchmark, I just would like, to give you just to put that into perspective. But, if you take companies like, darlings of the market, I would say, predictive, discovery. Predictive discoveries have, 4.1 million ounces at 1.6 grams. We are already, after 2 years, at 4.5 million ounces at 2 grams per ton. You take record resources, 3.9 million ounces at 2.5 grams per ton. After 2 years, we are already at 4.5 million ounces at 2 grams per ton indicated. Reunion Gold, 2.5 million ounces at 1.8. Great Bear, Great Bear is a good example. Great Bear, is 2.7 million ounces at 2.6. We're far more, away, than Great Bear, and this was acquired by Kinross at $1.6 billion. So this shows, how, important is, this discovery we have now in the portfolio, which is preparing the next phase of projects. So 2 to deliver next year, and then already preparing for the next, tier 1 phase of construction, for after, with a significant discovery that was done at the, we spend in total only $50 million in exploration to discover those assets, which is, where you create value. And you could buy, tomorrow, one of those, projects. It will cost you, half a billion or $1 billion. Then you would have, to put another $500 million just to develop them. So you will be all in, at 1 to 1.5 billion before, producing any gold. Tanda-Iguela, we've got already the project for $50 million.
Yeah, I can see what I was trying to get out of today's conversation is about how you and the board are, constructing this. I know you've kind of got your portfolio objectives of, under 1,000 bucks ASIC, and it was 10 years of production ahead of you at 1.5 million ounces, et cetera, et cetera. You've got these goals, and sometimes there's a kind of building phase. And I just kind of felt that this year was a kind of, you looked again, you almost like a reset moment. Let's go. That scale isn't necessarily the driver here; it's margin and what you can do for the share price. So,
I agree.
Would that be fair to say?
Yeah, I think it's quality. It's not a reset in terms of changing, the target. The target has always been to be, between in this range of, 1.4 to 1.6 million ounces, because I think that's the sweet spot. You don't need to be 2.5 million ounces and dilute the quality of your portfolio. Bear in mind that each year you need to replace depletion. So unless you want to be, 2.5 million ounce producer for 2 years and then drop, we feel that it's better, to keep, a low cost portfolio, so that whatever the gold price environment, you can maximize cash flow, and through that cash flow, you can invest it into your own business, both in developing new projects, investing in exploration, and that's the quality of West Africa. You've got so much better opportunities, for discoveries, and at the same time being able to reward your shareholders.
Okay, so what have we got? What does this put you in a position to do next year? Why does this kind of drive the price? Because if I'm investing in you, if I look over the past 3 years, I've got if I was timing it perfectly, I could have made a sort of stack of money. But if I'm sort of sitting back, I'm kind of feeling there's this sort of gentle sideways movement in what has been a difficult time for gold. This, I agree with you, okay, not a reset, but this new portfolio rebalancing of your cash position. What's it going to do for you over next year or the next 2-3 years, if you want to look out that far?
Sure. If you look at, you fast forward next year, 2 projects delivered on time and on budget, by year end next year we'll be, producing 1.3 million ounces, from 1.1, this year. At this current gold price, we'll be, fully deleveraged, so back to net cash positive on the balance sheet. And then, we still have this next Tanda-Iguela project and tier 1 assets, to come in the portfolio, 2-3 years down the road. So you've got a very healthy balance sheet. You've got, 1.3, 1.4 million ounce, portfolio at low all-in sustaining costs, generating strong cash flow. and therefore appetite, for further, shareholder returns, and at the same time still, organic growth, which a lot of companies are chasing now because, in this gold price environment, investors going to ask, where's your growth? And in fact, we've got that growth. So, and we've got that growth at low cost. And I think that's the beauty of, Endeavour Mining.